Hello, ladies and gentlemen. This is Thomas Fross here with Fross and Fross Wealth Management, where, as always, we at least attempt to be the voice of reason in a world full of the pundits of pessimism and that scary wall of worry. So, today I want to discuss the market volatility that's really spiked since last Wednesday's announcement by the White House of sweeping tariffs across the globe of most goods coming into our country. And whether or not that's a good thing or a bad thing is a totally different discussion, but it certainly has caused the market to kick up volatility. It kind of reminds me of maybe turbulence in an airplane. I was recently on a flight and the flight got really choppy, a lot of turbulence, and the pilot came over the intercom and he said, "Ladies and gentlemen, we apologize for the turbulence. If you're uncomfortable, just a reminder, we're on the plane with you. We know it's uncomfortable. But this plane was built for this kind of turbulence, and while we search for smoother air, make sure you keep your seatbelt on, but we're going to get you to your destination safely." And that's kind of like what we're experiencing right now. We're in it with you. Nobody looks forward to market volatility. It's uncomfortable. But that's what we're experiencing. So the major question, though, is what is the Fross and Fross Wealth Management Investment Committee doing to address the recent market developments? Well, in conjunction with the State of the Markets address that was held in February, we were already preparing for at least some level of volatility. As a matter of fact, long before this, back on January 29th, the Investment Committee unanimously voted to reduce risk in our managed IRA type assets by an estimated 7.5%. The purpose was to address, at least prepare, for volatility that we thought we would experience throughout the year based on what Trump had told us up until that point. Little did we know what he would announce last Wednesday. The committee voted not to make any changes in the non-qualified managed accounts due to the large capital gains that would be triggered and taxes owed on them. But given the recent market developments, the committee held a meeting, a very special meeting on Friday, April 4th, and unanimously voted to approve an immediate approximately 20% reduction in risk across the majority of all of our managed portfolios, both qualified and non-qualified. Importantly, there will not be making any changes within any of our third-party models, since we don't make the specific investment decisions within each of those accounts ourselves. We expect the investment manager that we've chosen to make those changes. We'll also not be making any changes to specific legacy variable annuity contracts, specifically because most of those contracts have underlying guarantees, whether they're income guarantees or death benefits, to address market volatility. This change is specifically for models that we here at Fross and Fross Wealth Management manage directly. Now, the decision was made after much deliberation. The view of the committee is that as long as the tariffs imposed by President Trump remain in place, there is an increased potential for risk to the downside. As a committee, we're not here to tell you when to completely get in or out of the market. Obviously, we don't have a crystal ball, but as a fiduciary, we must look at the portfolios from a holistic perspective. And given recent events, it's the committee's view that now is the time for a prudent reduction in risk. For non-qualified accounts, this can mean that capital gains could be triggered. This was discussed extensively by the committee. But the decision was made to move forward with the portfolio changes for one simple reason. The committee feels that the downside risk of not making changes to the portfolio is greater than the taxes that would be triggered by making those changes. And as prudent investment managers, we believe that increasing protection in the portfolio is beneficial at this time. As a result, we're making the following changes to our portfolios. We'll be eliminating our weightings to small cap stocks and large cap global stocks. At the same time, we'll be reducing our exposure to U.S. large cap growth stocks. Now, to replace these positions, we'll be adding to the portfolios gold, short-term treasuries, mortgage-backed securities, and global balance stocks. Now, during the State of the Markets address in February, Patrick, if you were there or saw the video of it, Patrick presented a chart that showed that going back to 1980, the S&P 500 has experienced an average of a 14.1 14.1% drawdown during each and every single year, which is roughly where we are now. And yet, going back to 1980, the stock market was still up the majority of the time. Basically, Patrick said you should wake up January 1st and expect at some point throughout the year there's going to be an intra-year drawdown of 14.1%. But don't panic, because the market will likely recover. And that's about, like I said, where we are right now. This may feel a little bit more painful since the majority of that drawdown has occurred just in the last few days, especially since Wednesday's announcement by the White House. But the principle still remains the same. This is the ebbs and the flows of the stock market. We've experienced phenomenal returns in 2023 and 24. This year's been the opposite, but it doesn't mean we've given it all up. As a matter of fact, I was looking back 2 years ago right now, the Dow was trading at 33,485. And even with the drawdown, we're still trading at 38,000. Still about 20% higher than we were 2 years ago. Just perspective. And just a reminder, we're investors, we're not traders. Markets rise and markets fall in the short term, but remember that the trade-off for outstanding returns of the past 2 years is unfortunately enduring some short-term volatility. The advisors here have built and will continue to build income plans to ensure that any schedule withdrawals that are needed are set aside and protected so that we don't need to sell out of equities when the market happens to be down. The fact is these are uncharted times, but during these times, it's important to keep a long time horizon in mind. And in other words, more than 3, 6 months, or maybe even 1 year. The changes that are being made to the portfolios are being made to protect against downside risk, but not to completely eliminate it, not to completely to get out of the stock market. You see, we believe it's important to remain fully invested. And I don't mean necessarily invested in stocks. As you know, when we've set up your accounts and we do our regular reviews, biannual reviews, we always discuss your risk tolerance and whether or not there's been a change to your risk tolerance or not. And if there has, we make adjustments to the portfolio. And we manage assets from capital preservation all the way up to aggressive growth. So if you thought the world was coming to an end tomorrow, we have a portfolio built for that. And if you think the market has hit a low and you think the market is going to shoot forward, we have a portfolio for that as well. See, it's not our job to set the speed limit that you're willing to drive. It's our job to drive the speed limit that you're comfortable driving. As we do that, we have the ability within each of our portfolios to tap the brakes, slow the vehicle down, or speed it up based on where we feel we are in an economic cycle. Right now, we're tapping the brakes. We're making prudent adjustments to address downside risk. And as soon as we see clarity and a path to clearer growth, we have no problem increasing the risk in each of our portfolios back to where they were in 2023 and 2024. On an end note, we do not take lightly the responsibility of nearly $1 billion in assets that we're managing in behalf of you. And we don't take it lightly. We take our job very, very seriously. And so in behalf of the firm, thank you for the trust that you've placed in us. As always, if you do happen to have any questions about your portfolio or any of the changes that we've made, I've attached the investment committee notes from our investment committee meeting last Friday. Those are attached as a PDF to this video. And if you have any questions, please feel free to reach out to your advisor or to Tucker Woods, who is our chief trader here at Fross and Fross Wealth Management. Have a wonderful day.